Sam Cosh is the lead manager of the European Assets Trust, part of F&C Asset Management. Joins me in the studio now. Sam, lovely to have you with us. And so talk to me a little bit about the opportunities in these markets at the moment for the long-term investor.
Okay, I think we're at the start of a slow, difficult recovery, lots of volatility about, but that gives the opportunity to go out and buy some really good assets at good prices. And what we're looking for at the moment is good quality businesses which have high barriers to entry, high returns on capital, strong balance sheets, and we think the market will sort of make a distinction between these sort of assets and the lower quality businesses during this cycle, because growth is going to be difficult to come by, financing difficult to come by. And if you looked pre-2007, actually abundant growth, abundant financing, lower quality assets could do quite well. But I think now you'll see a market share gainers being the good companies, market share losers being the lower quality businesses.
So you're saying that you like high quality assets, companies with strong cash flow, and your description makes me think of the large blue chip multinationals, but actually you're much more interested in small and medium sized businesses at the moment. Why is that?
Well, I mean, those are the areas where you get less, say, analyst coverage, you get more inefficiencies, you can get the...
And are therefore more difficult to understand?
Potentially more difficult to understand. Or actually, no, probably not, I'd say, because actually these are smaller businesses, fewer divisions, but actually strong niche businesses in their own right. So actually fairly straightforward, but the market ignores them because of, maybe the sell-side analysts don't make enough money covering them. There are liquidity concerns. But is
that starting to change now in the current environment, where perhaps it's difficult to find, a good strong income yield? Or
sorry.
Is that the sort of acknowledgement that there are opportunities to be had in, say, small and medium-sized businesses, and perhaps not just the large established names that many would perceive as being safe investments?
Yeah, I mean, I think typically you would expect higher yields with with larger, more mature companies, but you can still get very good yields with small caps. And I mean, I think at the moment when they're quite neglected, you can get a very, very high dividend yield with some high quality businesses. We own a company called Exact, which operates in the software company, pays out 100% of its earnings, so you get a 9% dividend yield with that. And we have a number of companies within the portfolio that do deliver high dividend yields.
And one of them that you mention here, Viscofan. Now, this is a Spanish company that makes that produces synthetic food. Would you describe it as that?
It's synthetic sausage skins, which might not sound that glamorous, but actually is a great place to invest because, well, for several reasons. It's a global oligopoly. They have pricing power, but you get long-term growth. It's not stellar growth, but it's above GDP growth for a long time. For a couple of reasons. You get emerging market diets changing, more meat consumption, which drives more growth in sausage.
So these guys are seeing strong demand in emerging markets?
They are, but there's a more subtle effect here in that you get a substitution effect from gut casing sausages to synthetic sausages because the supply of gut casing is reducing. Because grass-fed lambs, where you get the guts from, are reducing globally because the dairy herd is sort of taking market share on the pasture. So a lower supply of gut casings, higher pricing, you move to synthetic casing instead. Plus, using synthetic casings improves your manufacturing efficiency also. So this is a long-term, 10, 15-year trend, which is going to deliver you above GDP growth for a long time.
So gut casing that comes from lambs, supply of that is reducing.
Exactly.
So that is, you speak about niche, that is a good example of that rationale. But you also like KUKA. This is a robotics company. This is a German market leader.
Yeah, it is a German market leader, particularly in the robotics for auto companies. But the story here is one of robotics penetrating general industrials more deeply because firstly, robotics are much more sophisticated now and can replace a lot of the services, manufacturing services, but also globally, what you've had over the last 15 years is the manufacturing base moving towards emerging markets, but the cost of doing business in emerging markets are increasing, and actually you're seeing some manufacturing repatriating to Western companies. For example, in the US, you're seeing that because you can use these robotics to reduce your costs.
I asked just because I'm curious to clarify. You say that this company's benefiting from a rise of the increasing use of robotics in production.
Yeah.
So, but is that not more expensive though to get that sort of technology on board than just say, hiring the manpower.
No, because I mean, as I say, you know, over 10, 15 years,
Okay.
you've had it move towards, you know, we're talking outside the auto sector here. General industrials within emerging markets, rising wage costs is making that more expensive, and actually because of the sophistication of these robotics, you can replace the staff and you can do things much more cheaply. So you are seeing repatriation of manufacturing from emerging markets towards Western markets. And Amazon just made an acquisition in that area, which sort of demonstrates the value of those businesses.
There you go, perhaps some alternative opportunities there in the markets. Good to talk to you about that. Sam Cosh, lead manager of the European Assets Trust, part of F&C Asset Management.